got Dipan Mehta, Director, Elixir Equities, to start off. Of course, Kunal continues to be with us. Dipan, let me quickly ask you first off on Swiggy. This entire IOCC structure, does it start to help Swiggy catch up with the market leader, Eternal?
Good morning and thank you for
Good
having me on
morning.
your show. I'm not aware of this development and how to
Okay,
benefit, so we
sure.
basically stick to the fundamentals.
Right.
And in an industry like this, our kind of option is eternal because of the size, because it is ahead in when it comes to turning profitable. It's the market leader over there as well, and we've been investing in the stock right from the IPO. So don't really track Swiggy that closely. We like the industry a hell of a lot because of the dynamics and also because of the fact that it can open up a lot of opportunities. It has changed habits and clearly it's a great consumption play. But in our opinion, I think Eternal offers better risk return profile than Swiggy. But I think Swiggy also is fine if you're invested over there because the basic industry dynamics are good. I don't know whether this particular development opens up windows for more investments into Swiggy or not. Maybe it does, and that's I think beneficial for both companies.
Absolutely. Okay. So that's the take. Dipan, do we run the risk from an Indian market standpoint? And I'm zooming out a little bit now. Do we run the risk of crude spiking and some cool off in Indian markets? Is that at all possible, or do you feel that even a spike in crude, at least up to 100, shouldn't typically deter investors, at least at this point in time, given that we've already seen those levels higher than that as well?
See, Ash, I think that there are two factors which are acting as a very strong resistance and preventing the market from going to new highs, be it the large cap indices or the mid cap indices. And these two factors, first, of course, is the geopolitical event happening in Iran and its effect on oil prices, because that risk is just not going away. And in fact, again, we have gone back to a situation where the kind of rivalries may erupt again because the 60-day window to find a peace accord has lapsed. So that is one part, and that investors certainly are tracking. Although its effect has been limited so far, and we've seen good moves in select stocks and broader stock market, broader stocks per se. So that's one factor. And second is this continuous flow of paper. I think every week there are 4 or 5 IPOs coming through. Companies are going in for massive QIPs also. So a lot of money is being sucked out by the primary market and direct issuances by the companies. And that does restrict the flow coming into the secondary market. So that is another factor which is kind of limiting, I think, the indices and the entire stock market to move to the next level. And of course, from time to time, we are getting a lot of FI selling, but then it balances off also. There are days on which it is positive or almost nil. So, but the two factors which are preventing the market from going to the next level is, of course, the geopolitical event and its impact on commodity prices, particularly crude oil. And second is this fresh paper coming in from the new issues and QIPs.
And do you believe that till that sustains, you'll likely see a cap on the way in which the market moves, at least upwards?
See, I think that, I don't know how actually it will play out because these are very difficult to predict also. But, what we thought maybe a few weeks ago that now we are on the cusp of a takeoff, that doesn't seem to be so. I think that we may spend more time in the sideways movement till either of these two issues kind of get sorted out or we have fresh FI flows. I don't know how we'll get out of this particular kind of stalemate situation which we are in. But I mean, eventually markets have to move either higher or lower and they have to, kind of break out on the upside or the downside. But right now it seems more of a sideways movement, if you ask me, and how these things will play out, as I said, very difficult to predict. You could have a peace accord in Iran tomorrow itself and oil price go back to $70. Or at some point of time, I think the market trends tend to deteriorate, then IPOs also tend to disappear. So there are a lot of scenarios, but as I said, I think I'm not as gung-ho and as positive and as optimistic as I was maybe a few weeks ago. I'm trying to get a bit of a cautious kind of opinion just now and hold your horses, just don't keep on investing blindly. Keep the powder dry is a kind of thought or strategy which comes to mind.
Interesting. Dipan, hi, morning. So curious to know which all paper did you subscribe to, considering the IPO rush seems to be back clearly?
Nothing at all, I think, because the way the IPOs are structured, a large chunk of it goes on a discretionary basis to the pre-IPO investors, and then the qualified institutional buyers for the institutions. And then small portion comes to the retail. Over there also it is HNI and non-HNI, and it gets oversubscribed so heavily that the chance of getting any allotment is almost nil. I think the entire IPO structure needs to be looked at in such a way where there's complete and proper level playing field, which is not there just now. And therefore, investors like us, where the ticket size is much higher than what the amount is for HNI, we just don't get to participate in these issues. And also, this gray market thing is not very good, healthy for the secondary market or the primary market. Any gray market prices are susceptible to manipulation, and they tend to draw investors into poor quality IPOs as well. So I think that we need to relook at the entire structure. The exchanges have suggested a direct sale of shares on the exchange platform. I think that's a great story. Whoever wants to buy, whatever price they want to buy, they can put the bid. We have a cash in place for closing prices. Why not for IPO as well? And that certainly can, create a better environment, better price discovery, and a fair way to distribute shares of good quality companies.
Any such classification, whether there's more safety in large caps or small and mid caps, which have definitely been generating a lot better returns than large caps?
No, no, clearly our loyalty is to the small mid-cap stocks. That's where the growth is. And that's where we can play some very interesting micro investment themes also, be it HVDC or be it even, jewelry stocks or Alcobev stocks or, such sort of investment themes which are very strong, where there's secular growth. So that is provided only by small mid-cap stocks. Large cap stocks, still an avoid. Look at the complexion of large cap stocks. You've got the software services companies where there's a lot of uncertainty around AI. We've got the large cap banks where certainly the growth is slowing down. We are seeing increased competitive intensity, and companies over there, the larger ones, HDFC, ICICI, SBI, their pre-provisioning profits are a high single digit or low double digit, which will not generate adequate returns going forward. And then you have a lot of other large cap companies, conglomerates like say Reliance, where because of the holding company structure, there's pressure in from that context. So large caps are a total avoid. There could be a few outliers, few companies which can still sustain 20% growth, but they are far and few between. So our focus remains on small mid cap stocks. And as I said, there are a lot of investment themes playing out over there: defense, aerospace, HVDC, renewable energy, rooftop. There is so much of action happening over there that it's very difficult to take your eye away from those stocks. Although large cap appears to be cheaper, end of the day, growth has significantly slowed down over there, and that too in a secular manner. It's not like a cyclical. And secondly, the ROIs over there also are kind of drifting lower.
Makes sense. Okay.
Your liking, but also the ones which are have listed. Anything which is standing out from those? I mean, in the sense, the likes of an SBI, AMC. You've seen a bit of a cool off on some of those prices. Would you go out and buy any of those?
No, I like particular this Indo NIM, but as I said, you don't get any shares in the IPO, and then you see on listing just on fire. So anyway, it's a good company to track. I heard your interview, nice one over there. But two interesting IPOs are coming up in the next week, I think. One is this Skyways, which is into air freight, and its track record is phenomenal. Air freight within the entire logistics is a nice niche but high growth segment with very high entry barriers. So we like that company, reasonable valuations. And second is this another company called, I think, starts with A, Augmento or something, which is into gold, which has a gold platform, and it supplies, acts as like a middleman for gold and silver buyers. Yes, Augmont is the company name. Sorry, you got it right now. It acts as a platform for buying and selling of gold and silver for institutions, corporations. It also imports gold as its own gold refinery, and it's a pretty large business. I think 90,000 crores plus is the revenue. So, I mean, It's a very interesting business model, and again coming at quite reasonable valuations. And then there's of course Gaja Capital, Gaja Alternative is the name of the company, where now you'll get a choice to look at a private equity type of a AMC, and the kind of growth which good quality private equity player can offer is phenomenal. I think their growth rates will be higher than the mutual fund management companies, maybe equal to higher than the wealth managers also, because there's a lot of appetite for high return, high risk, high return products which companies like Gaja Alternative do offer, and a lot of money which they are raising, they want to themselves invest in the companies that they have identified. So a lot of interesting IPOs keep coming, but as I said, the chance of getting them at reasonable valuations in the IPO window are very small for a certain class of investors. And then when you go on the secondary market to buy, there's sometimes a lot of buzz around it, and they're 30-40% higher, and that doesn't provide adequate margin of safety.
Run-up has been steep in pharma.
Usual disclosures that we and our clients are invested. I think we are the most recent acquisition in our portfolio is Wockhardt, where we feel that the base business is now stabilized and is a good profit engine. And then whatever upsides come from new molecules, that is really the icing on the cake. But on the whole, I think a lot of companies are showing good potential over there. Particularly impressed with DB's Laboratories also, and also Acuitas, which is another kind of a CDMO player. Then there's Rubicon Research. I think that kind of do the numbers and kind of work which they are doing. I thought Land Pharma also, the dynamics are looking pretty good over there. So wherever I think companies have a slightly differentiated business model, which are not just taking the same kind of local business plus US generics, those businesses we tend to avoid. But something special is there. Those are the businesses where I think we have got good growth prospect. But yes, I think entire pharma industry can get re-rated, and you can find a few good winners over there. It's a difficult industry to track, but end of the day, I think there are many opportunities opening up for them.
And it seems